Good afternoon, everybody. Welcome to the 77th session of Zentax Talks. So we would like to start the session by thanking each and every one of you for showing your continuous support to all our webinars till now, and please do keep showing your support for the upcoming webinars too. So as you all know, today's topic is latest judgments under GST. When you talk about latest judgments or just about judgments, why do you think it is very important when it comes to tax statutes? I feel it's important in terms of two things. One is to help the taxpayers understand on how to interpret a tax law or how to apply the same in their business. And additionally, it is also important to protect the interests of the taxpayers. That is, we'll be looking at the very next case itself, how the government is going beyond its powers and legislative abilities to just bring transaction into a tax statute to collect tax from the taxpayers. Therefore, it is important for any kind of judgments, any kind of judicial authority to always have a say, to always have an authority to provide a ruling in any kind of tax issues. Therefore, today we'll be discussing on very few important case laws that have come up in the past couple of months, and we've tried to make it very simple and very understandable. Let's jump into the case laws. The very first case law deals with supply. So as we all know, GST is a tax on supply of goods and services or both. So therefore, here the supply is the main taxable event under GST. And this taxable event under GST has been defined under section, or has been, the scope of this supply has been provided for under section 7. Now section 7 reads as, for the purposes of this act, the expression supply includes. So it gives an inclusive definition. It does not say only this is included in supply and this is not included in all. It just says it includes all forms of supply of goods or services or both, such as sale, transfer, barter, exchange, license, rental, lease or disposal, made or agreed to be made for a consideration by a person in the course or furtherance of business. Therefore, the important elements in these is supply. What and all can be construed as supply, consideration should be there, and it should be in the course or furtherance of business. So this is given in section 7, subsection 1, clause A. Now clause AA goes on to further broaden the scope of this supply provided in section 7. It says, the activities or transactions by a person other than an individual to its members or constituents or vice versa for cash, deferred payment or other valuable consideration. So in the above explanation, in the above clause, it is provided that supply includes all these kind of different supplies, sale, transfer and etc. They've gone further to say activities or transactions by a club or association to its members will be considered as supply. And they've also provided an explanation stating, for the purposes of this clause, it is hereby clarified that notwithstanding anything contained in any other law for the time being in force, or any judgment, decree or order of any court, tribunal or authority, the person and its members or constituents shall be deemed to be two separate persons, and the supply of activities or transactions inter se shall be deemed to take place from one such person to another. So section 7, subsection 1, clause AA says, activities or transactions by a club or association to its members will be considered as supply. And it also says, it goes on to say, this club or association and its members will be considered two separate persons, and therefore any transaction between them will be taxable. Now, with this clause of AA, they've also introduced section 2, clause 17, subclause E, which states, provision by a club, association, society or any such body for a subscription or any other consideration of the facilities or benefits to its members will be considered as business. So they are trying to bring this transaction or activity of a club to its members into the scope of supply. First of all, they are saying activities or transactions by the person to its members is a supply. They are also going on to say that there shall be a consideration for any kind of provision provided by them, and therefore it is considered as business. So this clause AA and this introduction of inclusion of club or provision of club or association in business happened via the Finance Act 2021. Though it was inserted on 28th March 2021, it was made effective from 1st July 2017. So this has been a retrospective amendment. Now let us look at what do you all think could be the basis for which a retrospective amendment can be brought into. A retrospective amendment can only be brought in situations such as an error has already been existing in law and this amendment has only been brought in to correct the error, but it does not change the essence of the law that was already existing. And additionally, if at all there is any kind of clarification needed, the retrospective amendment could be brought in. Therefore, in this case, it is the stand of the department that this insertion of clause AA is a retrospective amendment for the reason that it is only a clarification, because they have very cleverly mentioned in the explanation that it is hereby clarified. But does it mean just because of these words, this will also be considered a supply? See, another point here to be noted is that the activities or transactions, if at all they were already existing in clause A, that is all form of supply of goods or services, why was there a need to specifically state such words of activities or transactions? And additionally, in the explanation, they've also mentioned that the person, that is the club or association and its members, shall be deemed to be two separate persons. So what does this mean? It means while the amendment was brought into effect, the existing point was that the club and its members were not considered as two separate persons. They were one and the same. Therefore, the supply of the club to its members is essentially the members supplying services to themselves, is not supply under GST. So just by bringing in this amendment to the scope of supply, do you all think that this can be a taxable event in GST? See, the word supply is been introduced under the Articles of Constitution. So as we all know, Article 246A of the Constitution is from where the power to levy tax under GST is provided to the Parliament and the Legislature, and that too the power is on supply of goods or services. That Constitution does not go on to say that supply includes a meaning of deemed supply or anything of that sort. It is very plain, and it says supply of goods and services. Here, there are two attempts by the department to override the Constitution. They are broadening the scope of supply in a statutory amendment, not a constitutional amendment, and they are also bringing in a deemed supply as a taxable event under GST. So this section has been discussed in a detailed manner in the upcoming case law. And before jumping into the case law, we'll also look at another few points to be understood before reading the case. So Article 246A, as I already mentioned, it confers powers on the Parliament and the Legislature, that is the Union and the states, to make laws with respect to GST, that too on the supply of goods or services. And this supply, the word supply, it does not give any artificial meaning stating deemed supply is also included in this. Now, another thing to be kept in mind is that the explanation to 7 subsection 1 clause AA says the club and its members will be association or club and its members will be deemed to be two separate persons. However, as per a prior ruling by the Supreme Court in the judgment of Calcutta Club, it has been very well established that a club or association and its members are not two separate persons, and principle of mutuality should be considered. So principle of mutuality is given in the slide. It says, it just simply goes on to say principle of mutuality means the club and the member are not separate from each other, and thus the service made by them would only go on to mean a self-service or self-supply, which is not covered under the term supply in the Constitution. So based on this judgment of Supreme Court in Calcutta Club and prior judgments also, the Constitution in the prior indirect tax regime under the sales tax, the Constitution by itself was amended because there was an attempt to bring in transactions that did not fit into the meaning of sale of goods. Therefore, what they did was they amended the Constitution to include the entry that is supply a tax on the supply of goods by an incorporated association or body of persons to a member thereof for cash, deferred payment, or other valuable consideration was deemed to be a tax on the sale or purchase of goods. See, two important things to be noted here is to broaden the scope of sale, concept of sale under the sales tax, they had to amend the Constitution and not just the statutory, that is not just the Sales Tax Act. So statutory amendment did not work there. Only the constitutional amendment was working there. Additionally, you should also note that this amendment was only in respect to goods and not services. Therefore, these two important points have also been discussed in detail in the judgment. So also it is important to understand GST is supply tax on supply of goods and services. To understand the supply of goods, we obviously don't need to know that there existed two persons, because I myself can't supply goods to myself. So I need another person to have enable the supply of goods. However, for supply of service or for the words supply and for service, to prove their existence, there should be two persons, one recipient and one supplier, without whom it would not be a supply or a service at all. Now, this supply or service, which says it needs at least two persons, was understood as such only under the Constitution also. But it was excluded. That is, the principle of mutuality was excluded from both the supply and service because of this amendment to Section 7 and Section 2. Therefore, and additionally, as we saw, the scope of supply was amended, and the scope of business was also amended. However, the definition of service was not amended to include services provided by clubs or associations to its members. So these are also important points to be kept in mind in regards to the amendments. So yes, as we discussed, this principle of mutuality concept was discussed in the Calcutta Club case by the Supreme Court. And it is also important to note the 46th Amendment, though it amended the Constitution by bringing in a supply of good by an association or club to its members, it did not amend the principle of mutuality in itself. Therefore, there was no explicit amendment to the principle of mutuality, which goes on to say the principle of mutuality was in existence even during the introduction of amendment of Section 7 under GST. And additionally, with respect to retrospective amendment, it should also be considered. That is, the principle of fairness should be considered. The rule of law is that every action by the state, that is the legislation or the parliament, it should be explainable to the taxpayers. Therefore, it cannot simply be just for the sake of increasing the revenue. The parliament or the legislation cannot just simply introduce a law and ask the taxpayers to simply abide by it. They should be able to inform all their actions with reasons. Therefore, keeping all these points in mind, let us look at the case law of Indian Medical Association, Kerala versus Union of India and others. And in this case law, the Indian Medical Association, being the club or association, it filed a writ petition with the Kerala High Court fearing coercive action from the DGGI. So what was the basic fact of the case is that Indian Medical Association is operating various mutual benefit schemes for its doctors, like Social Security Scheme, Professional Disability Scheme, and etc. Through these schemes, the Indian Medical Association, it gives payouts to its members or families in the situations of death, disability, or litigation. And against this, the Indian Medical Association is collecting some membership fees or annual subscriptions and fraternity contributions. So what happened was that this medical association, Indian Medical Association, believed that they are not liable to GST on these services, citing the principle of mutuality. That is, the association and the members are one and the same. They are not different persons, and hence there is no supply of any transactions between them. And also, they mentioned that the amendments to the CGST and the KGST Act introducing the deeming provisions, deemed supplies, is not constitutional, and also the retrospective amendment has proven to be a burden on them, increasing their financial liabilities. Therefore, the Indian Medical Association wanted the High Court to declare the unconstitutionality of the amendments brought in and the retrospective amendments also. Therefore, now initially the case was heard by a single judge, and the single judge, the findings of the single judge was that they said they upheld the amendments. They said principle of mutuality can't be a point of contention here, because with the introduction of section 7 clause subsection 1 clause A, the principle of mutuality has been done away with. That you can't quote it anymore, as there is a statutory amendment. However, the single judge considered the point of retrospective amendment, stating it leads to various financial burdens, and also that the taxpayers were unaware of it initially or prior to the amendment. So the retrospective application of such amendment was quashed, and the amendments were held as constitutional only. Now, both the taxpayer and the department, they once again had gone to the High Court, and they said the taxpayer wanted the ruling in favor of them in the issue of constitutional validity of the amendments. The department wanted a ruling in favor of them in terms of the retrospective amendment. They wanted the retrospective amendment to be made valid. And what happened in the case was, now in the next hearing, that is in the multiple member hearing, the submissions of the petitioner are as follows. They said principle of mutuality cannot be simply done away with, because even the 46th amendment to Constitution itself could not change it. How can a statutory amendment bring about a change for principle of mutuality? As we know, principle of mutuality says that a club or association and its members are not distinct entities for taxation purposes. So there are also judicial precedents which support these transactions, stating that club and associations are not separate from its members. And additionally, the next point was that the CGST and KGST Act are only creating deeming supplies between the associations and members. And the constitutional validity of these amendments are challenged because these amendments are exceeding their legislative competence under Article 246A. Additionally, the retrospective application of these amendments was criticized as unfair, imposing unexpected tax liabilities on associations. See, apart from this, if we look at some notable points in the submission of the petitioners, they are: principle of mutuality applies to incorporated clubs also. As per previous judicial interpretations and precedents, it applies to not just unincorporated clubs or associations. It applies to incorporated clubs also. That is, even if they're incorporated, the club or association and its members are not separate legal entities. They are one and the same. And there cannot be a transfer between a same person. Therefore, there is no transfer or no supply between the club and its members. And this principle of mutuality survived the 46th Amendment to the Constitution. Therefore, it says the statutory amendment cannot do away with the principle of mutuality, as it was already in existence, and it is also recognized by the Constitution of India. Additionally, only the Constitution can expand what the Constitution has given. So the Constitution has given supply of goods or services are taxable under GST. Now, supply has been very clearly mentioned in the Constitution. If at all the scope of supply is to be increased, the Constitution should be amended to increase the scope of supply and not the statutory acts. And additionally, in the previous amendments, that is the 46th Amendment to the Constitution, we saw that to broaden the scope of sale of goods, the Constitution was amended. The sales tax was not amended. So what could be done only by constitutional amendment earlier cannot be done by just a statutory amendment now. Even now, if it was to be done properly, the Constitution should be amended to include this supply. And additionally, another point is that the 46th Amendment does not cover services. As we read earlier, we saw that it covers only tax on purchase of goods, purchase or sale of goods. It did not talk about purchase or sale of services. And supply of goods and services, it cannot cover all activities or transactions. If it was to cover all activities or transactions, there would not be any need to define the scope of supply. Additionally, another point is that these activities or transactions, if they were already covered in the section 7, subsection 1, clause A, why is there a need to bring them explicitly in another clause of the same section? And if at all there has been a settled law, you can't just introduce something as clarification and do away with the existing law. There has to be a reason for the amendment in the existing law. So the submission of the petitioner was heard by the High Court, and the submission of the respondents are as follows. They said it is not something new. Something new has not been introduced to the Act. There has been no broadening in the scope of supply. It was existing already in section 7, subsection 1, clause A, and section 2, clause 17, subclause E. Therefore, the department contends that these sections existed with effect from 1st July 17, and that itself made supplies of goods or services by clubs or associations to its members taxable effective 1st July, irrespective of the amendments made. Therefore, the amendments are only clarificatory in nature, and they don't improve or broaden the scope of the supply. And the next point was that most of the clubs or association in the country had already taken registration and started paying GST even before the insertion of section 7, subsection 1, clause AA. And they also said, since these clubs or associations did not have any doubt as to the liability of GST, it cannot be held that this was a surprise, this was a new insertion of an act. This was already existing, and even the taxpayers abided by it. And the next argument by the respondents was that the respondent and its members have all along been different persons because the association had an income tax PAN that is different from its members. So for all these points, the submission of the petitioner was that the contention of the department saying most of the clubs or association had taken registration and paid liability can't be held as a valid ground because that does not provide, that is not the taxable event under GST. A taxable event has to be established in the Act. A mere following of another taxable person, a mere payment of tax by another taxable person does not obligate the association to pay the tax without looking for the taxable event in this case. And if at all the income tax PAN is being brought in as a ground of contention, the petitioner also mentioned that under Income Tax Act, the PAN is only used for the purposes of declaring income other than the income, income on other services from outside services rendered to other persons or received from other persons. It does not cover the activities or transactions conducted to the members of the association. Therefore, bringing in Income Tax Act and the Income Tax PAN is not a valid ground for the by the department. And a few notable points by the respondent, that is the department, was that you are talking about Article 246 of the Constitution of India and saying principle of mutuality existed, and the Calcutta Club case was also as per the previous indirect tax regime as per Article 246. Therefore, this argument is totally invalid as GST is under Article 246A of the Constitution. And the next point is that The power to make laws for the GST, for collecting tax under GST is provided in Article 246A and 366. There are no restrictions, explicit restrictions or limitations to the government to make such laws. And while there are no such restrictions, the taxpayer cannot read into such powers and say that the department can do this, that is, the parliament can do this or cannot do this. And they also went on to say, when there is no restriction in the power, there is also no restriction in the supply, the term supply, that is the power to broaden the scope of supply. If the parliament or the legislature is willing to broaden the scope of supply, they can do so. They don't have any limitations as per the constitutions. And they also mentioned that the term supply or any kind of legal statute introduced by the parliament or the legislature should be read with a broader intention. The intention behind the introduction of such sections should be understood. So the terms supply should be understood as if it included the activities or transactions of clubs and members, clubs or associations to its members. Now the court said to the respondent that you are right. The legislature has the power to enact validating laws that remove the basis of invalidity pointed out by the courts in relation to earlier unamended law. They said, okay, you are right. You have the power to make amendments if at all any invalidity was pointed out by the courts in the existing law. That is, the law was existing, there was an invalidity in the law, and it was not amended. A court gave a judgment and the legislature has the power to amend it. However, in this case, the proceedings is different. It is with respect to whether it would be competent for a legislature to levy tax on a transaction when the taxable event in relation to the subject of taxation had not been recognized by the Constitution. Or in other words, when the Constitution has understood a taxable transaction as necessarily involving two persons, can a legislature deem a transaction that does not involve two persons as a taxable transaction? So the court said, the Constitution says supply of goods or services. Supply means there should be two persons. So the Constitution is giving power to make laws only to the extent of supply made between two persons or two or more persons. Does the Constitution, does the legislature has power to go and say the supply between the same persons, that is the club or association to its members, will also be a taxable event under GST? And this is the question that is being discussed as per the High Court in this case. Now the court also went on to say, when the words used in the constitutional text have acquired a meaning through judicial interpretation over the years, one must assume that that is the same sense in which the word is used when inserted into the Constitution through a later amendment. Therefore, the term supply, the term services, everything, while it has been understood in the same sense over the years, over various judicial precedents, the term cannot mean a new thing or a different thing just because it has been introduced under a new law, new act, under the GST Act. And as we discussed earlier, while goods is a standalone concept, meaning it does not need plurality of persons to infer its existence. That is, if we talk about goods, transaction of goods, it is physical, and we are obviously going to have two persons, two or more persons involved in the transaction. However, in the concept of supply and service, it requires a plurality of persons to infer their existence. To say that there is a supply at all, there should be two persons. You can't say there is one single person and there is a supply. If you can't say there is a supply, then there is no taxable event under GST. And there is no liability for tax payment by the respective person also. And therefore, it can be safely assumed that the scheme of GST also contemplates the existence of two persons, that is a provider and a recipient, before one can infer either a supply or services for the purposes of the levy. In other words, the concept of self-supply or self-service are not envisioned under the Constitution for the purposes of the levy. And in contrast to the above, what has been done through the present amendment to the CGST SGST Act is merely to amend the definition of supply to include activities or transactions by a person other than an individual to its members or constituents or vice versa. Significantly, such supply has not been deemed to be a service, and the concept of service itself has not undergone a change. Therefore, the court says, see, it is not even a supply as per the constitution. Now, what has been done is there is a mere amendment to the term supply in the act. And even then, even if you say there is an amendment to supply, you have not gone ahead and amended the term services. Therefore, the court said the amendments are unconstitutional. The principle of mutuality, it remains intact. That is, the association and its members are one and the same, and there can be no taxable event on self-service by the association to its members. And it is substantiated further by the court saying a supply of service requires two distinct entities, and thus services rendered within an association should not be considered taxable under GST. Now, the next point is regarding retrospective taxation. So, considering principle of fairness, the court found that the retrospective taxation was deemed unfair as businesses were unable to foresee and account for such liabilities. So, finally, the court gave verdict saying the amendments are unconstitutional and void, invalidating the retrospective tax demands. So, this discussion has been on Section 7, Subsection 1, Clause AA, which is about the services of association activities or transactions by clubs or associations to its members. So, this verdict by the High Court, we'll have to wait and see what is the further action from the revenue or the government with regards to this High Court decision. And it does not mean that since the Kerala High Court has ruled in favor of the assessee, all other state high courts, if the issues arising in other states, the high courts are going to rule in accordance with the judgment of the Kerala High Court. One such example is the next advance ruling that we are going to discuss. In this, the court held that the amendment is void and it is not at all a supply. However, in the next advance ruling, a different stand has been taken by the advance ruling authority. So, this advance ruling is for the applicant Crimson Dawn Apartment Owners Association, Welfare Association, and this advance ruling was, we had represented the applicant, that is our senior experts, CA Paul Thangam sir and Arvind Thangam sir has represented these apartment, Crimson Dawn Apartment, the applicants, and the basic facts of the case are as the applicant, that is the Crimson Dawn Apartment Owners Welfare Association, is a resident welfare association registered under the Tamil Nadu Societies Registration Act. Therefore, this is also an association. And the point of doubt for the applicant was that they are collecting subscription fees from its maintenance charges from its members on a quarterly basis. So that is also been asked as a query. Additionally, the main question in this advance ruling was that the association is collecting a corpus fund or a sinking fund, and it is this corpus or sinking fund is recorded as a liability in the balance sheet, and this fund is collected for the purpose of meeting the future capital expenses such as painting, repairing or replacing major equipments like lifts and generators. So the question before the advance ruling authority was that whether these collections of subscription or maintenance charges, quarterly charges, and the corpus fund is subject to GST, and what is the tax rate applicable on the same, and if at all it is subject to GST, can they claim ITC against these collections, are the questions put forward before the advance ruling authority. Now, in advance ruling, as we all know, along with the questions, we also submit the interpretation of the act from the applicant's point of view. So, the applicant interpreted the law as follows. They said this corpus or sinking fund should not be liable to GST for the following reasons. They said the nature of collection, that is, the fund is collected and maintained separately from the regular maintenance charges collected on a quarterly basis. Now, this fund that is being collected is for future capital expenses. It is not for, they are not sure of the expenses that would be incurred in the future. They just are saying that this fund is for the future capital expenses like painting, repairs, and equipment replacement. So they say that this collection is a capital contribution rather than a payment for immediate services. And they also refer to the definition of consideration. They are saying that consideration is defined as a payment for the supply of goods or services. Since they say this is not, there are no immediate services, this is a capital contribution, there is no specific supply relatable to this collection. Therefore, this is outside the scope of taxable transactions. Now, since we are talking about the definition of consideration, we'll have a read at the definition. It says, consideration in relation to the supply of goods or services or both includes any payment made or to be made, whether in money or otherwise, in respect of, in response to, or for the inducement of supply of goods or services, whether by the recipient or by any other person. So from this first clause, it is very clear that this payment which is being made is in respect of or in response to or for the inducement of supply of goods or services. However, the applicant is sure of the fact that there is no specific supply of services that can be linked to the corpus fund which is being collected. And let's look at the proviso to section 2, clause 31. It says, provided that a deposit given in respect of the supply of goods or services or both shall not be considered as payment made for such supply unless the supplier applies such deposit as consideration for the said supply. Even this clause, the clause of the proviso of deposits, it says, if there is a deposit being collected, it shall not be considered as payment for a supply at all until the supplier is using such deposits for rendering the services. Therefore, the applicant is very sure that the amount collected by them is not at all consideration because there is no specific supply involved. Since it's not a consideration, there is no specific supply. Their interpretation is that GST is not applicable to the corpus fund. And they also have additional points, additional contentions saying that this corpus fund, it represents an enhancement of common infrastructure. That is, it is not directly linked to services provided to individual members. They are reserved for unforeseen or uncertain future expenses. Therefore, they do not constitute taxable supply. And they also address the fact that these funds saved up for future expenses are purely uncertain. They are not sure if at all the expenses would be incurred, or when they will be incurred, or on what it will be incurred. Since there is no specific supply attributable to such corpus fund, it should not be subject to GST. And the final point interpretation is that as per the Societies Registration Act, they are mandatorily required to collect corpus fund. So therefore, any mandatory requirement from another law due to any collection of amount due to another mandatory requirement cannot be subjected to GST is their interpretation. Now, the authorities' response to all these interpretations are as nature of collection. In the very first point itself, they are saying it is a supply. See, the corpus fund or the sinking fund by the association is not a deposit, but an advance payment for the services. They are saying that the amount that is being collected is with the intention of providing future services, right? Therefore, it is a supply of service, and this will be considered as consideration as per section 2, clause 31, subclause A. That is, any amount received for the purpose of in respect of or in response to a supply of service. Therefore, they are saying that it is supply and it is also consideration, and it is squarely GST is fairly applicable on such transactions. And their interpretation or their response to the applicant saying it is a supply is based on this section 7. They say, as per section 7, scope of supply includes the following. It includes all forms of supply of goods or services or both, such as sale, transfer, barter, exchange, license, rental, lease, or disposal made or agreed to be made for a consideration by a person in the course or furtherance of business. So they've established that it is a supply, saying it is for future, it is earmarked for future services. Therefore, it should be considered as supply. They've also said since it's a supply, the amount received will also be consideration. Now they're further going on to say that this association or club will be considered a person as per GST Act, as per section 2 clause 84, where person includes an association of persons or a body of individuals, whether incorporated or not, in India or outside India. And they further go on to say that any provision of services, any provision of transactions by an association to its members, to the benefits of its members, shall be considered as business. Though they covered section 7 saying it is a supply, there is a consideration, the supply is made by a person and it is made in the course or furtherance of business. Based on all these interpretations, and they've also said that the application of funds has been collected, the funds have been collected, even though not applied immediately, it has been collected with the intent to provide services, making it liable to GST. The future uncertainty cannot be used as an excuse, because this fund is specifically earmarked for specific services like maintenance expenses. The applicant is saying that they're not sure of the specific expenses. However, the authority is of the view that if you are saying that you're going to provide future maintenance expenses, it is earmarked for a specific service. Therefore, there is no future uncertainty of the fund being of the amount being used for any expense. And also, they are saying that just because it is mandatory to collect corpus fund under the registration Societies Registration Act, it does not make it, it does not take it outside the scope of GST. If the taxable event is happening in a transaction, if you can find the taxable event in a transaction, then it is obviously applicable under GST. Therefore, based on all this, the advance ruling authority has ruled that the taxability of corpus fund would be that it is taxable as per section 7 of this GST Act. Since the fund is used for maintenance and repairs, it is not treated as a deposit, but as an advance payment for future services. So it's basically treated as an advance for services and is liable to GST. And the rate and classification they provided that it is covered in the SAC 9995 and it is taxable under GST at the rate of 18%. Now, another question was regarding to exemption threshold for the monthly maintenance received on a quarterly basis. They said if the maintenance charges are below 7,500 per member, then it is exempt as per notification number 12/2017. And however, only the monthly maintenance charges are exempt, not the corpus fund earmarked for a future expense. Therefore, corpus fund is, however, taxable under GST. Now, ITC, they said you are eligible to claim ITC. However, you should exercise caution and apportion the ITC on taxable and exempt supplies. The exempt supplies in this case would be the monthly maintenance charges below rupees 7,500 per member. Therefore, apportionment of the ITC was advised by the advance ruling authority. So you can very clearly see how the law is being interpreted by different authorities. While Kerala High Court goes on to say that Section 7 clause AA is not at all relevant, it is not at all constitutional, the advance ruling authority has interpreted it in a different way. Therefore, we have to wait for a final decision on this taxability of associations or clubs and draw a conclusion on the issue. With respect to this advance ruling, we are in the plans of going for further appeal to the appellate authority for advance ruling to fight out this issue and get the issue in favor of the applicant. Now we've seen two important judgments with regards to supply. Let's look at one important judgment with regards to ITC also. As we all know, ITC, a recipient is eligible to claim ITC only after fulfilling the eligibility criteria as per section 16. Now, under section 16, subsection 2, important points are that possession of tax invoice or prescribed document is required, and the details of such document should be furnished by the supplier in the statement of their outward supplies, and it should be communicated to the recipient as per section 37. And additionally, the services or the ITC should not be restricted under section 38. And the tax on such supply should have been paid to the government. These are three important conditions. Now, this is also substantiated in Rule 36(4), wherein it says ITC that can be availed in GSTR 3B should be equal to or less than the eligible ITC in GSTR 2B, as mentioned in section 16(2) that we read just before. Now, we also saw another condition which said ITC should not be restricted as per section 38. Now, 38 talks about communication of details of inward supplies and ITC. It says the eligible ITC of the recipient, that is the outward supplies of the supplier of the recipient, should have been declared by them in their outward tax return, that is their GSTR1, and it should be reflected, communicated to the recipient in the auto-generated form GSTR2B. Only then they can claim ITC. Even if the supplier has declared their outward supplies in GSTR1, in their GSTR1, and even if it's been communicated to the recipient, the additional restrictions under section 38 says the details of ITC available to the recipient should be there, and which is not eligible should also be provided. When will it not be eligible? Even if the details are furnished, however, even if the details are furnished by the supplier, but the supplier fails to make payment of such outward supplies, he makes a default in making payment and continues the default for a certain period of time. Also, if he has paid the tax amount, but he has not paid the full liability declared in GSTR1, therefore non-payment of tax by the taxpayer and short payment of tax by the taxpayer is also an issue even after the supplies being declared in their GSTR1 and being communicated to us in our GSTR2B. So that now we have understood the restrictions with regards to tax payment by supplier with regards to ITC in case of tax payment by suppliers. One important decision which just came very recently on 30th May is that the decision by Allahabad High Court in the case of RT Infotech versus Additional Commissioner Grade 2 and 2 others. So in this case, the appellant, that is RT Infotech, was a registered supplier, and they were in the business of mobile recharge services. They had purchased the recharge coupons from Bharti Airtel Limited against 7 tax invoices, and they've discharged the GST on these invoices through RTGS banking channels. Now they said they fulfilled their tax obligations. They have paid the tax to the supplier. But the department goes on to say the tax has not been received in the government treasury. You have said that you've made payment, but we have not received the payment. Therefore, we are not going to provide ITC to you. Now the submissions by the petitioner are, we have fulfilled our tax obligations. We have no control over the supplier. We don't know, we can't control if the supplier is paying the tax or not. And they also quoted some legal precedents of the judgment by the Supreme Court in the Suncraft Energy case and the judgment by the Madras High Court in the DY Beethal Enterprises case, where they said, they mentioned that both these cases emphasize that the action should be taken against the supplier rather than the recipient. And they also mentioned that this proves unfair burden on the purchasing dealer. It provides unfair financial burden. I'm also paying tax to the government, to the supplier. I'm also paying tax to the government. So it's an unfair burden on my part. So additional point was that in this case, in this specific case, an action was already initiated against Bharti Airtel, that is the supplier of RT Infotech. However, this has not been considered before initiating any proceedings on RT Infotech by the adjudicating authority. And they say it is because of this, the order passed on them should be invalid, as the first point of recovery of tax should be from the supplier rather than the recipient. Now the respondent, that is the department or the additional commissioner, they go on to say ITC eligibility is linked to tax deposit with the government. See, the payment of tax by the recipient to the supplier is not what is important here. The government should have received the tax from the supplier. Therefore, since Bharti Airtel did not pay the tax, the petitioner, that is RT Infotech, cannot claim the ITC. They further mentioned that it is the responsibility of the purchaser, that is RT Infotech, to verify that the supplier had declared the outward supplies and also made the payment of their tax obligations. But we all know very well, except for GSTR2B, the recipient has no means to ensure payment of tax by the supplier. Therefore, this point is very invalid argument from the respondent. And their final contention was that if at all the ITC is being provided to RT Infotech right now, it would lead to revenue leakage, undermining the integrity of the GST system. So this would mean that ITC, we have also foregone the revenue. We are also providing ITC to the recipient. Therefore, there is a revenue leakage to the department. Now, what has the High Court analyzed and ruled in this case is that they said, yes, we agree with the submissions of the petitioner that the purchasing dealer cannot compel the selling dealer to file their returns or to pay the tax within time. It is the responsibility of the assessing authority to verify whether the payment has been done by the purchasing dealer, and if at all any actions are ought to be taken, it should be taken against the selling dealer, and the benefit should be given to the petitioner, that is the recipient of the supply. And the High Court clearly mentioned in their wordings, this is exact wordings used in the case. The Honorable Apex Court in the case of Suncraft Energy had occasioned to consider that the party who has paid the tax on invoices being raised and non-discharge of duties by the counterpart of the seller, the court was pleased to remand the matter for making due inquiry from the supplier. So this is the exact wordings used by Allahabad High Court in this ruling. We look at the applicability or the validity of this reference in the next slides. They had additionally referred to Madras High Court's decision in DY Beetal Enterprises versus State Tax Officer, wherein it was held that simultaneous action should be taken on both the seller and the purchaser, and the purchaser alone shall not suffer without taking action against the seller. And accordingly, based on all these analysis, the High Court said that these orders are not sustainable in the eyes of law, and they are hereby quashed, and the matter is remanded to the respondent, that is the additional commissioner, to start a fresh proceeding and provide a speaking order in the case of the taxpayer, that is RT Infotech. Now, we read that the High Court in this decision had quoted these words saying the Supreme Court in the case of Suncraft Energy was pleased to remand the matter for making due inquiry from the supplier. Now, what actually happened in the decision by Supreme Court in the Suncraft Energy Limited is given in this screen. So, the Supreme Court listened to both the petitioners and the respondents, and they said, having regard to the facts and circumstances of this case and the extent of demand being on the lower side, we are not inclined to interfere in these matters in exercise of our powers under Article 136 of the Constitution of India, and hence the special leave petitions are dismissed accordingly. So it clearly it is a very clear judgment wherein the Supreme Court said, see, this is we are not inclined to interfere in this because the demand is on the lower side. Therefore, we are dismissing this petition, and there is no mention of any remand to the lower authority or the department to reconsider the issue. Therefore, it is very important to have caution, exercise caution while depending on the case law of RT Infotech, because this quote by the High Court can be considered invalid and erroneous, because the Supreme Court has never, not even a single word has been taken from the Supreme Court's judgment. In fact, it has ruled something else. It has said the petition was dismissed and it did not interfere in the matter. Therefore, caution is to be exercised in this case. And this is with respect to ITC, an important judgment with respect to ITC. Another important aspect is excess stock found at the time of search. Now, this has been discussed in various case laws by the Allahabad High Court. Before jumping into the case law, we'll look at the relevant provisions. So, for the excess stock at the time of search, where does the power come for the proper officer to demand tax on such excess stock? It comes from section 35, subsection 6. Now, 35, subsection 6 says, subject to the provisions of clause H of subsection 5 of section 17, where the registered person fails to account for the goods or services or both in accordance with the provisions of subsection 1, the proper officer shall determine the amount of tax payable on such goods or services or both that are not accounted as if it had been supplied by such person under the provisions of 73 and 74. So they are clearly saying if any account, if the person has failed to account for goods or services, any goods or services, and the proper officer is initiating any proceedings for demanding the tax payable, it should be only under 73 or 74. Now, what are the goods or services for which account has to be maintained? I mean, what are the accounts that has to be maintained as per subsection 1 is given in this slide. It says every registered person shall keep and maintain at his principal place of business, as mentioned in the certificate of registration, a true and correct account of production or manufacture of goods, inward and outward supply of goods or services or both, stock of goods. So the excess stock would be the stock when compared with the accounts and records maintained and the physical stock. Therefore, if at all there is an excess unaccounted stock and the proper officer is demanding tax on the same, it should be under section 73 and 74. We will also have to look at section 130, which talks about confiscation of goods or conveyances and levy of penalty. Now, this section says the relevant clauses, we'll read the relevant clauses, where any person does not account for goods on which he is liable to pay tax under this act or contravenes any of the provisions of this act or the rules made thereunder with intent to evade payment of tax. So the first one says they should have paid tax on certain goods which they were liable to pay, but they have not accounted such goods. And the next one is they've contravened the provisions of this act with an intent to evade tax. Under these circumstances, all such goods or conveyances shall be liable to confiscation and the person shall be liable to penalty under section 122. So we saw earlier in section 35, tax payable should be under section 73 or 74. Here, section 130 is talking only about penalty. Now, let's look at it in a practical case. So in the case of Janata Machine Tools versus State of UP, Allahabad High Court ruled, had a detailed interpretation of section 35 and 130. So the case goes like this. So the taxpayer is a partnership firm engaged in the purchase and sale of machines, machinery parts and hardware goods. So the firm approached the High Court to challenge proceedings initiated under section 130 of the GST Act. So during the search, the department found the excess stock, unaccounted stock, and then they proposed a tax demand of 7,17,560 along with equal penalty under section 122. So section 122 provides for penalty of 10,000 or the tax payable, whichever is higher. Therefore, the higher amount is 7,17,000 and the goods were also confiscated. Now, the contention of the firm is that section 73 and 74 is the only applicable sections under which tax has to be demanded from the taxpayer, and 130 is not the provision. And a few notable points here is that 130 provides for confiscation of goods and levying penalty. It nowhere says that proceedings can be initiated as a notice can be issued or an order can be issued or so much demand can be raised. All these have been provided only under section 73 and 74. Now the Honorable High Court observed the following. It said, it is very clear from section 35(6) that in the proper officer to determine any tax payable, they will have to go back to section 73 and 74. Now the proper action by the officer in this case should have been to go to section 74 for the unaccounted excess stock lying with the taxpayer. And even if such excess stock was found, the proceedings under 130 cannot be initiated because for the sake of argument, even assuming that the goods were lying in excess of the goods in record, the case against the petitioner would not fall under clause 2. That is, clause 2 talks about does not account for any goods on which he is liable to pay tax under this act. Because it would not fall under clause 2 for the simple reason that The liability to pay the tax arises at the time of point of supply and not at any point earlier than that. See here, there are goods lying in excess and they are liable to tax. However, there has not been a tax liability till now. And additionally, scope of clause 2 is that any assessee who is liable to pay tax and does not account for such goods after the time of supply is occasioned. Therefore, it says these goods lying in excess, it is liable to tax, but then the point of supply has not yet, time of supply has not yet been triggered. 130, the clause 2 of section 130 subsection 1 is only at the time where after the time of supply is occasioned. Therefore, for these simple reasons, clause 2 shall not be applicable. Why will clause 4 not be applicable? Because the contravention of the act should be coupled with the intent to make evade payment of tax. Therefore, both these clauses shall not be applicable, and hence section 130 of the act will not be applicable, and the proceedings should be initiated under 73 and 74 if at all any excess tax is stock is found at the time of search or survey. So moving on, the next case talks about non-filing of monthly returns and non-payment of GST can also constitute suppression of facts if willful misstatement or fraudulent intentions have been proved. So, see, there are numerous taxpayers who don't file their returns on time or pay taxes on time, right? Have we ever imagined that it would also be liable to proceedings under section 74? I'm sure most of us would not have envisioned this, because however, this case law gives a different picture on interpretation of the facts of the case. In the case of Shriba Nirman Company versus the Commissioner Appeals Guntur, the Andhra High Court ruled that if the taxpayer, if the suppression of facts, that is the non-declaration of information, is with the intent to evade tax, then it shall be, the proceedings can be initiated under section 74. So as we all know, non-payment of tax would attract penalties under 74 under three circumstances. One is fraud, second is willful misstatement, third is suppression of facts. And suppression of facts has been explained in explanation 2 to section 74, where it says non-declaration of information is also suppression of facts. Now, can we say every suppression of fact, every non-declaration of information would be liable to penalty under section 74? No, each case has to be looked into individually for ascertaining whether necessary evidence of fraud, willful misstatement or suppression of fact for the purpose of evading tax is available in the record and whether such material has been demonstrated before the authority. That is, there should be a clear evidence that there has been a suppression of fact with an intention to evade tax. Only then section 74 can be invoked. Now, in this case, the taxpayer argued that they had not filed their monthly returns, not paid the taxes, and not filed the annual returns. However, their time limit to file the annual returns had not yet expired. They said, we will file the returns also within the due date of annual returns. And the next point was that before issuance of notice, they had paid the tax amount, tax demanded. However, under section 74, it is important to note that 74 in itself is an amnesty scheme, because it says if the taxpayer is accepting by themselves and paying the tax interest, then their penalty would be only 15% before the issuance of the notice. In this case, the taxpayer paid only the tax amount, not even the interest. Therefore, their contention that they paid the tax before issuance of notice and hence no proceeding should be initiated on 74 is invalid. And their another reason behind their non-filing of returns and non-payment of tax was that one of their main customers did not pay them the amount on the supplies affected to such customer. However, the court on its analysis found that non-filing of monthly, that is the statutory requirement to file monthly returns and pay GST, is independent of the annual return deadline, and non-compliance with the non-filing and non-payment of monthly returns and monthly tax liabilities is liable to penalty. There is no provision to give them a leeway in this. And next one is that they also found that the main customer, that the taxpayer said they have not received the amount from the main customer, due to which they faced financial burdens and could not pay the taxes was in fact untrue, because the taxpayer had in fact received certain little amount of consideration from the their customers, which they could have very well used to pay the taxes and declare the outward supply. However, they failed to do so, which proved their intention to evade tax. And therefore, they considered that non-filing of monthly returns and non-payment of GST can constitute suppression of facts if it is willful and intended to evade tax. So the next case is regarding the very infamous Safari Retreat judgment. We all know that the Supreme Court ruled in favor of the assessee in the Safari Retreat judgment, to the extent stating that it remanded the case back to the Orissa High Court, saying conduct a functionality test and see if the building constructed by Safari Retreats is eligible for ITC under the Act. However, in the latest GST Council meeting, it has been recommended that Section 17, subsection 5, Clause B will be amended to make plant or machinery into plant and machinery to restrict ITC on such supplies, which would in fact be available based on the Supreme Court judgment interpretation. Now, the latest update on this is that the Chief Commissioner of Central CGST went for a review petition stating there is an error apparent on the record of the judgment, and therefore the judgment should be reviewed and it should be a new judgment has to be passed. However, the Supreme Court just ruled, it dismissed the review petition, saying there is no error apparent on the record. This is the latest update with respect to Safari Retreats judgment. The next case is also fairly a simple one. It is regarding the pre-deposit to be paid at the time of filing appeal. The discussion is regarding whether credit balance in the electronic credit ledger can be utilized for paying the pre-deposit. So in this order, Union of India and versus Yasho Industries Limited, the Supreme Court ruled that, already the High Court of Gujarat had ruled in favor of the taxpayer. So the Supreme Court just said that we find that the order by the High Court would not call for any interference. Hence, the special leave petition is dismissed. They said they don't want to interfere in the decision of the High Court. Now the High Court ruled in favor of the taxpayer, saying that Section 107, subsection 6, Clause B only states 10% of tax liability has to be paid as pre-deposit before filing the appeal. It does not explicitly state only cash has to be used. Cash balance has to be used to pay such pre-deposit. And additionally, Section 49, subsection 4 also says the balance of ITC balance in the electronic credit ledger can be utilized for any tax payment under the GST Act. And this is further substantiated by circular number number as displayed on the screen. Even in this circular, the CBIC has clarified that the ITC balance available in the credit ledger can be utilized for any tax payment under the GST Act. Therefore, it is well settled that the credit balance, ITC balance in the electronic credit ledger can be utilized for the payment of pre-deposit in case of filing appeals. Now, coming to the last case law of discussion for the day, this is another one interesting and an important provision that taxpayers should be very carefully aware of. In this case of Khanna Engineering versus Commissioner of CT and GST, Orissa High Court ruled that once penalty is paid by the taxpayer under section is paid, as per section 129 subsection 5, all proceedings under this section shall stand concluded. So as we all know, in terms of detention of goods while in transit, proceedings would be initiated under section 129, and the relevant provisions are 129 subsection 3, which says the proper officer detaining or seizing goods or conveyance shall issue a notice within 7 days of such detention specifying the penalty payable, and thereafter pass an order within 7 days for the payment of penalty. So it is very clear Initially, a notice will be issued. The penalty payable should be specified in the notice. And the order would be issued mentioning the payment of penalty to be made, meaning that if the penalty was not made under notice, obviously the next stage would be to issue an order for the payment of penalty. And 129(5) says, on payment of amount referred in subsection 1. So subsection 1 gives the percentage of penalty, that is 200% of tax has to be paid as penalty in case of detention of conveyance in transit, goods in transit. So it says, on payment of amount referred in subsection 1, all proceedings in respect of the notice specified in subsection 3 shall be deemed to be concluded. It says the department is issuing a notice and the taxpayer is paying the penalty after issuance of notice. All proceedings will be concluded. No further order can be issued. Now, in the case of Khanna Engineering, the taxpayer's truck was detained. MOV 07 was issued on the same day. The taxpayer also paid the penalty on the same date for the release of the truck. Now, what they did was they paid the penalty after the issuance of the notice. Since the payment has been done at the notice level itself, the authority, the proper officer, did not provide any further order for the same. Now, the taxpayer approached the Orissa High Court saying they want an order to appeal against the penalty paid and get it as refund. However, the Orissa High Court did not entertain such petition, and it said once penalty is paid as per the provisions of the Act, the proceedings are closed. No further orders shall be issued. Therefore, this is one very important section that the taxpayers have to exercise caution to protect their interests, because payment of penalty only at the time of notice stage itself would not entail the issuance of an order, and the taxpayer can't go for an appeal and can't fight for the penalty amount paid. So as I said, this is the last case for today, and follow us on our WhatsApp channel to get the latest updates. We keep posting all these latest judgments as info bites in our WhatsApp channel, so you can get to know them in real time. So please follow us on WhatsApp, and any queries or any suggestions on the session and any future so we have one question from Mr. Sitaram sir. He has asked, we are a textile mill with 2,500 workers covered under Factories Act. We are running our own canteen and providing subsidized food to our workers. Should we collect GST from canteen deduction from our workers? Sir, the specific position on this is that it looks like you are actually collecting amount on the canteen supplies. And the basic interpretation, or from all the advanced rulings of the Tamil Nadu authorities, collection of any amount for canteen supplies will be liable to GST, sir. And the next question is, excess stock. Can proper officer levy penalty for difference of stock amount between actual stock and stock reported to bank? It is not exactly actual stock and stock reported to bank. They would look at all your records and charge tax on the difference between the tax the stock reported by you in your financial statements and the physical stock, sir. And Surya Narayanan sir has said, kindly make separate webinar for Safari Retreats Judgment for clear understanding. Sir, we have an extensive, we had a separate webinar by our CEO, Mr. Arvind Tangam sir, on the same, where an extensive interpretation was done of the case. It is available on YouTube channel. You can please refer to the same. Nevertheless, we'll keep this in mind and we'll also have a future discussion on Safari retreats, sir. Can we go for appeal for interest paid and late fee paid? Sir, it depends on the facts of the case. Just simply looking at your query, we are not able to understand what are the facts of the case, sir. The next question is regarding e-waybill penalty under section 129. How much penalty applicable without e-waybill? E-waybill expired. Sir, your query is regarding the percentage of penalty applicable, right? So e-waybill expired is also as good as there is no e-waybill. So under both these cases, 200% of the tax payable would be demanded as penalty, sir. The next question is corpus fund taxable? Sir, as we very clearly discussed in the advance ruling in the case of Crimson Dawn Apartments Association, it is the interpretation of the advance ruling authority that the corpus fund is taxable under GST. However, we are not in agreement with the same. It depends on the case and the taxability that has to be established, sir. So since we are way past time, it's 4:20. Any further questions, please mail to our mail ID. It will be displayed on the screen. So yes, any feedbacks, any further questions, please send them to the mail ID. And we look forward to meeting you in our next webinar. Thank you.